The US Mint just halted production of silver eagles. Again, they claimed it was a machine failure. It wasn't. It was a supply failure. For the first time in history, industrial demand for silver has exceeded mining output for 48 straight months. We are burning more than we find. This is exactly what happened to rhodium in 2007 before it went up 4,000%. The physical metal is gone. Only the paper price remains. And when the paper burns, the panic buys begin. Welcome to the reality the financial media is paid to ignore. If you look at the spot price of silver today, you see a number. Maybe it's $30, maybe it's $32. You see a chart that goes up and down. You see a commodity that looks boring, stable, plentiful. That is an illusion. It is a digital hallucination designed to keep you in the dollar. Because if you look behind the curtain, if you look at the geology and the mathematics, you see something else entirely. You see a crime scene. We are currently living through the greatest disconnect between physical reality and financial fantasy in human history. We call it the silver deficit, but that's too polite. A deficit is when you overspend your budget. This isn't a deficit. This is an extinction event. We are witnessing the transformation of silver from a monetary metal into unobtainium, and we are deep in stage 3 of the collapse pattern. Stage 1 was the printing of the money. Stage 2 was the inflation of the assets. Stage 3 is the disappearance of the physical inventory. Stage 4 is the price reset. And it doesn't happen gradually, it happens overnight. Today, we are going to break down the physics of this crisis. Not the speculation, the physics. We are going to look at the mines that are empty, the solar panels that are devouring the world's supply, and the vault numbers that prove the COMEX is running on fumes, the window is closing, the metal is leaving the system. Let's look at the evidence. Let's start with the dirt. Because you cannot print silver, you have to dig it, and the dirt is telling us a terrifying story. It's called ore grade degradation. In 2005, for every ton of rock a mining company dug up, they might get 13 ounces of silver. Today, they are lucky to get 4. Think about the physics of that. You have to move 3 times the earth, burn 3 times the diesel, use 3 times the water, just to get the same amount of metal. Energy costs are up, labor costs are up, machinery costs are up, but the price of silver is suppressed. What does that do? It kills the supply. Look at Mexico, the world's largest producer. Output is crashing. Why? Because the easy silver is gone. We mined it all in the 1900s. Now we are scratching at the crust, chasing dust. There have been no major silver discoveries in a decade. None. Exploration budgets have been slashed. Why would you spend millions looking for silver when the paper price says it's worthless? So the mines are aging, the yields are collapsing, and the timeline to bring a new mine online is 10 to 15 years. If we found a massive deposit today, right now, the second, it wouldn't produce a single ounce until 2040. Do you understand the lag? The supply cliff isn't coming in 10 years. We just drove off it. Global silver production has peaked. It is in structural decline. Physics doesn't care about the Federal Reserve. Physics dictates that we are running out of cheap silver. This isn't just about mining. This is about basic geology. Silver is rarely found by itself. It is a byproduct. We find it when we mine for copper, lead, and zinc. 70% of the world's silver comes from these base metal mines. So what happens when the global economy slows down? What happens when we stop building skyscrapers and we stop needing as much lead or zinc? The miners stop mining those metals. And guess what happens to the silver supply? It vanishes. We're entering a global recession. Manufacturing is contracting. That means base metal mining is contracting, which means silver production is about to fall off a cliff, exactly at the moment demand is exploding. It is the perfect storm. A supply shock meeting a demand shock. So the supply is dying. But the demand is exploding. And it's not because people are buying jewelry. It's because of the green revolution. They told you they want to save the planet. They told you they want net zero. Fine. But they forgot to do the math. You cannot have a green revolution without silver. It is the most conductive metal on the periodic table. Not the second most, the most. You need it for solar panels. You need it for EVs. You need it for 5G. You need it for every single Tomahawk missile and smart bomb. Let's talk about solar. 10 years ago, the solar industry used 5% of the annual silver supply. Today, it uses nearly 20%. By 2027, it is projected to use 30% or more. One industry, devouring 1/3 of the global supply. And here's the trap. They can't substitute it. They tried. They tried using copper. They tried using aluminum. It doesn't work. The efficiency drops. The panels fail. If you want high efficiency energy, you must use silver. It is inelastic demand. That means the price can go to $100, $200, $500 an ounce, and Apple, Tesla, and Samsung will still buy it. Because without the silver, their product is a brick. They don't care about the price, they care about availability. And right now, the availability is flashing red. Look at the electric vehicle market. A standard combustion car uses maybe 20 grams of silver. An EV? It uses up to 50 grams. The charging stations? Even more. The AI servers being built by Amazon and Microsoft? They run on silver contacts. We are moving into an electrified world. Electricity requires conduction. Conduction requires silver. It is a mathematical funnel. The entire digital and green economy is trying to squeeze through a door that is getting smaller every single day. Consider the military application. This is something nobody talks about because it is classified. But we know the physics. You cannot guide a missile without silver. You cannot build a satellite without silver. The contacts in a fighter jet? Silver. In World War II, silver was so critical that the US government took silver from the Treasury to make wires for the Manhattan Project. They didn't have enough copper, they used silver. Today, we are depleting our stockpiles while geopolitical tensions are at an all-time high. If a major war breaks out, the demand for silver won't just double. It will become infinite. The military will seize every ounce of production. Civilian access will be cut to zero. Let's look at the numbers. The Silver Institute is the official body. They are conservative, they hate alarmism, and even they are panicking. For the last 4 years, the global silver market has been in a deficit. 2021, deficit. 2022, record deficit. 2023, another massive deficit. 2024, on track to break the record again. We are consuming roughly 1.2 billion ounces a year. We are mining roughly 800 million ounces. Do the math. Where's the extra 400 million ounces coming from? It's coming from the vaults. It's coming from above ground stockpiles. We are eating the seed corn. We are draining the strategic reserves of the last 40 years to keep the price of iPhones low today. But here's the thing about stockpiles. They end. You can draw down inventory for a year, maybe 5. But eventually the vault is empty. When that happens, when the strategic buffer is gone, the price discovery mechanism switches from paper to physical, and that switch is violent. It's not a curve, it's a step function. The price flatlines, 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 and then it teleports. We are watching the inventory bleed out in real time. London vaults, bleeding. COMEX vaults, bleeding. Shanghai vaults, empty. China knows this. Why do you think China is banning silver exports? Why do you think the Shanghai Gold Exchange commands a premium over the New York price? Because they are hoarding. They are draining the West of physical metal before the lights go out. They see the pattern. They know that silver is a strategic military asset, and they know the West is asleep at the wheel. This brings us to the concept of unobtainium. In economics, price is supposed to fix scarcity. If silver gets scarce, the price goes up, miners dig more, and the market balances. That is the theory. That is what they teach you in school. But what happens when geology says no? And what happens when you can't dig more, no matter how high the price goes? What happens when the lead times are 15 years? You enter a period of price inelasticity. The price uncouples from reality. We saw this with Palladium. We saw this with Rhodium. Rhodium was $500. Then the auto industry realized they didn't have enough for catalytic converters. Why? Because Ford and GM had to have it at any price. If they didn't have that tiny ounce of metal, they couldn't sell a $50,000 truck. So they bid, and they panic bid. Silver is rhodium on steroids. Rhodium is only used for cars. Silver is used for everything. Electronics, medicine, energy, war, water purification. It is the most indispensable metal on Earth, and we are running it like a liquidation sale at a bankrupt furniture store. Imagine the panic when Samsung realizes they can't get delivery. Imagine the panic when Raytheon can't build guidance chips. They won't be buying futures contracts on the COMEX. They will be sending armed guards to the refineries to take physical delivery. That is the moment the paper market dies. That is stage 4. If this isn't a crisis, what is it? This is the setup for the squeeze of the century. But to understand why the price hasn't exploded yet, we have to look at the criminals. We have to look at the paper market. We have to look at the COMEX. If everything I just told you is true, if the mines are empty and demand is record-breaking, then why is silver cheap? Why hasn't it exploded to $100 yet? This is the question that keeps people broke. They look at the price and think, the market knows best. The market knows nothing, because there is no market. There's a crime scene. We've looked at the geology. Now we have to look at the rigging. We have to look at the paper market. This is the mechanism they use to suppress the price, but it is also the mechanism that will destroy them. Because every Ponzi scheme has a mathematical limit, and the COMEX just hit theirs. Here is how the scam works. It's called rehypothecation, a fancy word for fraud. In the real world, if you have one house, you can sell it to one person. In the COMEX world, they take 1 ounce of physical silver and they sell paper claims on that ounce to 100 different people, maybe 200. Some analysts say it's 500 to 1. Think about that. For every ounce sitting in a vault in New York, There are 500 people who think they own it. They hold a digital contract. They see silver in their brokerage account. But they don't own metal. They own a promise. They own an IOU from a bank that is technically insolvent. Why do they do this? To dilute the price. If you want to keep the price of beach balls down, what do? You print 500 million tickets for beach balls. The artificial supply of paper silver floods the market. It absorbs the demand. When you go to buy silver on an ETF like SLV, you aren't buying metal. You are buying exposure to the paper price. You are helping them rig the game against yourself. The banks, JP Morgan, Citigroup, they use this paper leverage to smash the price whenever it tries to rise. It's called the tamer. Every time silver rallies, mysteriously, at 2 a.m. when the markets are thin, billions of dollars of paper silver are dumped instantly. Does a miner dump a year's worth of production in 10 seconds at 2 a.m.? No. A manipulator does. They are shorting metal they don't have. They are selling ghost silver. It has worked for 40 years. It worked because nobody asked for delivery. Nobody said, "Give me my metal." Everyone was happy to trade the paper receipts. But the music has stopped. The stand for delivery movement has begun. Look at this chart. This is COMEX registered. These are the ounces of silver that are actually available to be delivered to fulfill those paper contracts. In 2021, there were 150 million ounces in registered. Today, we are hovering near 30 million. That is an 80% collapse. Gone. Vanished. Taken. 30 million ounces. That sounds like a lot. It isn't. At current prices, that is roughly $1 billion. Elon Musk could buy all of it with the change in his couch cushions. And a single hedge fund could wipe out the entire registered inventory of the COMEX in one afternoon. We are razor thin. We are operating on the fumes of the fumes. The banks are playing a game of musical chairs, but there is only one chair left, and there are 500 fat bankers circling it. What happens when registered hits zero? What happens when a major industrial user, say Tesla, shows up with a valid contract, demands 10 million ounces, and the vault manager says, "We don't have it"? That is the force majeure event. The COMEX will declare an emergency. They will cash settle the contracts. They will write you a check for the last traded price. Here is your 32, but you can't buy silver for 32. The real price in the street will be $100, $200, $500, and you will be holding worthless paper currency while the physical metal disappears into private vaults. You think this is impossible? The government won't let it happen. The banks are too strong. Let me introduce you to rhodium again. In 2006, rhodium was a boring industrial metal. Most people had never heard of it. The supply was tight, but the market was managed. But there was a difference. Rhodium didn't have a futures market. There was no paper suppression. It was a pure physical market. So when the deficit hit, there was no paper buffer. There was no way to print fake rhodium. Manufacturers needed it. Miners didn't have it. Panic. Sheer, unadulterated panic. The price went from $500 to $10,000 in a straight line. It happened fast. It happened violently. And if you weren't holding the metal before the move, you didn't participate. You watched. Silver is rhodium with a coiled spring on top of it. The paper short on silver is a massive compressed spring. They have been pushing it down for decades. The energy stored in that compression is nuclear. When the COMEX breaks, when the paper scam fails, that spring releases. We won't just see a rhodium spike, we will see the short squeeze of the century. The banks who are short will be forced to cover. They will have to buy back billions of ounces that don't exist. They will bid the price to the moon trying to save their own skins. It will be a transfer of wealth from the paper speculators to the physical owners. It will be biblical. Let's look at the psychology of the commercial shorts. These are the bullion banks. They are the smartest guys in the room. They have the algorithms, they have the high-speed connections, and they are trapped. They are short millions of ounces. If the price rises by $5, they lose billions. If the price rises by $10, they are insolvent. They are fighting for their lives. This is why the volatility is so extreme. This is why they smash the price every time it breaks technical resistance. They are not trading for profit anymore. They are trading for survival. They are trying to keep the lid on the pressure cooker. But the fire underneath is getting hotter. Every time they smash the price, they create a new problem. Low prices stimulate demand. Low prices discourage mining. By keeping the price artificially low, they are actually making the shortage worse. They are digging their own grave, deeper and deeper, hoping a miracle will save them. There is no miracle coming. There is only math. Let's talk about the lease rates. This is inside baseball, but it's critical. When silver is plentiful, the lease rate, the cost to borrow silver, is low. Sometimes it's negative. Right now, lease rates are spiking. This means banks are desperate to borrow silver to cover their shorts. They are paying high interest just to get their hands on physical bars for a few days. This is backwardation. Backwardation is a technical term that means panic. It means the market is willing to pay more for silver now than for silver in the future. That shouldn't happen. In a normal market, future prices are higher because of storage costs. When you see backwardation, it means the shortage is here. It's not theoretical, it's operational. The gears of the machine are grinding, the grease is gone. We are watching the structural disintegration of the London and New York pricing mechanism. It is happening in slow motion, and then it will happen all at once. And who is on the other side of this trade? Who is taking the physical metal while the West sells paper? The East? China? India? Russia? India imported 70 million ounces last year. They are buying the dip. Every time the banks smash the price, Indian housewives and billionaires back up the truck. They know gold and silver are real money. They don't trust the rupee. They don't trust the dollar. We are seeing a flow of physical metal from west to east, from the vaults of London to the vaults of Shanghai and Mumbai. Once that metal leaves the West, it doesn't come back. It is gone forever. The West is selling its family silver to pay for cheap credit. It is the end of an empire. What triggers it? What is the snowflake that starts the avalanche? It could be anything. It could be the U.S. Mint shutting down again. It could be a strike at a major mine in Mexico. It could be Russia launching a gold-backed currency. It could be a single headline: Apple buys silver mine to secure supply. But the most likely trigger is simply attrition, the slow, steady bleed of the vaults until there's nothing left. We are watching the countdown. Every month, the deficit grows. Every month, the vaults shrink. Every month, the solar demand hits a new record. We are walking toward a mathematical cliff. The smart money has already positioned themselves. Why do you think J.P. Morgan amassed the largest hoard of physical silver in history while they were suppressing the price? Read that again. They suppressed the price so they could buy it cheap. They know the game is ending. They flipped the switch. They are long physical now. They are waiting for the explosion. And who are the victims? The people holding paper, the people with savings accounts, the people who think the dollar is real money. Let's talk about the geopolitical angle. The BRICS nations: Brazil, Russia, India, China, South Africa, and the new members. They are actively de-dollarizing. They are building a new payment system. And bridge? The unit. What are they backing it with? Commodities, gold, oil, metals. They are not going to trade in U.S. treasuries. They are going to trade in things that have real value. Russia has officially classified silver as a strategic asset. They are building their stockpile. China has restricted exports. The world is splitting into two spheres: the financial sphere, the West, based on debt and paper, and the commodity sphere, the East, based on energy and resources. Silver is the bridge between these two worlds, but it lives in the commodity sphere. As the East rises and the dollar falls, the purchasing power of silver will realign. It won't be priced in dollars. It will be priced in energy. It will be priced in value. And in that world, an ounce of silver isn't $30. Historically, the gold to silver ratio is 15 to 1. It comes out of the ground at roughly 8 to 1. Today, the ratio is 85 to 1. That means silver is undervalued by a factor of 6 or 7 relative to gold, and gold is undervalued relative to the money supply. Do the multiplication. If gold goes to $3,000 or $5,000, which it will, and the ratio returns to historical norms, we are looking at $200, $300, $400 silver. This isn't a moonshot prediction. This is a return to the mean. This is gravity. History always returns to the mean. It might take a decade, or it might happen in a week. We are betting on the snapback. So what do? We are deep in stage 3. The shortages are visible. The premiums are high. Stage 4 is the break. When stage 4 hits, you won't be able to find silver. Online dealers will display sold out. Local coin shops will be empty. The price on the screen will say one thing, but the buy button will be grayed out. The solution is simple, but it requires action. You must move from digits to atoms. Get out of the banking system. Get out of the ETFs. If you can't hold it, you don't own it. It is a cliche because it is true. Buy physical silver. Buy it now while it is still available. Don't worry about the price. Whether you pay $30 or $35 won't matter when it's $300. What matters is that you have it. How do you buy it? Focus on low premium bullion, bars, and rounds. You don't need numismatics, rare coins. You need weight, you need ounces, 10-ounce bars, 1-ounce rounds, junk silver, pre-1964 quarters and dimes. This is the best fractional silver. It is recognizable. It is hard to counterfeit. It is perfect for barter in a worst-case scenario. This is not an investment. This is an insurance policy against the collapse of a fraudulent system. It is a vote against the paper Ponzi. It is a claim on the future of energy and technology. Let's talk about the exit strategy. People always ask, when do I sell? When do I trade my silver back for dollars? This is the wrong question. It shows you are still thinking in the old paradigm. You don't sell your silver for dollars. You trade your silver for assets. You wait until the ratio shifts. You wait until 1 ounce of gold buys the Dow Jones. You wait until 500 ounces of silver buys a house. It has happened before. In Weimar, Germany, a gold coin bought a city block. In Venezuela, an ounce of silver feeds a family for months. The goal is not to get more dollars. The dollar is the Titanic. The goal is to get a lifeboat, and then trade that lifeboat for land, for a business, for freedom. That is the transfer of wealth. The mines are empty. The vaults are draining. The industry is desperate. The setup is perfect. The greatest wealth transfer in history is happening. And it's happening in silver. The train is leaving the station. Are you on it? Or are you standing on the tracks? Subscribe. Turn on notifications. Because when stage 4 begins, I won't need to tell you. You'll hear the panic from your neighbors. Be right. Be early. Be prepared.